Happy Friday, traders. It's 8:01 a.m. Chicago time, 9:01 Eastern on the 16th of December 2016. Thanks for joining me. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The overall stance of the market this morning is bullish across the board except for the Japanese yen US dollar. And just now, the Russell fell below its closing price yesterday, trading 9 ticks below. So fairly unchanged. The treasuries are fairly unchanged. A quick reminder to everybody, again, I did push out a couple warnings on Twitter and so on regarding this, but today's quad witching Friday. Expiration for uh, U.S. equity indices is at 8:30 Central, 9:30 Eastern, right at the cash close. And then other products have expired already. The Eurex products expired at 6 a.m. Central, and the CAC 40 and others expired about 10 a.m. Central, 11 Eastern. So today is one of those days where some of the action may not make sense. It's important today to recognize that and to recognize that there's still some positioning, hedging, and so on, and it might lead to you know the market being fairly choppy. So it's important to be very picky today and patient, especially going into the weekend. Just bear that in mind, okay? Other than that, the news, uh, the latest news is that the U.S. housing starts came out weak at 1.09 million versus 1.23 million. Building permits also came out weak for November, 1.2 million versus 1.24 million. Uh, the numbers that came out at 7:30, these two numbers pretty much wrap up the week. We have Baker Hughes at 1 Eastern, but again, that's not a mover. And then at 12:30 Eastern, we have Fed Speaker Lacker. Other than that, there's really nothing on the calendar barring any news, tweets, and so on. Um, it's likely to be a fairly quiet day. Overall, the overnight news flow has been pretty steady. There's stuff coming out of Europe, the UK, and EU leaders reach an agreement on Brexit. The UK has to pay a pretty hefty amount when it triggers Article 50. They have to pay 50 billion pounds, which is about 62 billion dollars, as soon as that's triggered. So that's a sort of a penalty against the UK pulling out. And then, of course, there's inflation out of Europe coming in at 0.6%, fairly strong year over year for November. This is the highest level of inflation in 2 years, and of course, that's what the ECB wants to see. It wants to see inflation, and that gives it some room to work with interest rates and so on. Okay, for those of you who did not watch yesterday's video, I do invite you to watch yesterday's Trader Bite. I do cover what interest rates increasing might mean to the S&P and other indices, as well as the stocks in the S&P 500. I go over the fact that even though it seems ominous and it seems like the end of a bull run, this hasn't been the case historically. We don't know what's going to happen here this time. But I'm just looking back at history, and I included a review of a yield curve chart, an animated yield curve chart over time versus prices on the SPX, which is the cash S&P index. Yesterday also, the primary hypothesis was for the market to push up and return into line and get back into the 6250 area. 6250 area where the point of control is that we left behind for the Fed. That's right up here. That was the key expectation. I did post right after. I did warn during the trader bite. Warned shorts that they're likely to get pushed out or get squeezed. Um, because the price is expected to rise back and come into line with where we've been as far as equilibrium over the last couple of days. The exploration below on the Fed is one that showed a lot of bullish behavior down here. If you watch order flow, you would have seen a fair amount of buying down here. Um, and so the expectation was to get back in line and drive back towards that 2262, 2264 area. And that's basically what it did. That was the primary hypo. The secondary hypo yesterday was for it to test higher early, find its sellers if there are still sellers available from the FOMC announcement, and then push back. But again, I warned also that Thursday's trade would be an inside trade to Wednesday's, and I'm not expecting the market to escape the range. What we did yesterday was basically trade inside of the prior day's value. So here's what we got. Okay, let's clean this up. This is what we got yesterday, a quick test down and then a push right up to the point of control, right up to that 6250 area, a little chop, and then it pushed right back up to the value area high. This gray area on my charts is value, is the prior day's value. Push right to value area high, and then it sat sideways. And if there was a point yesterday where the point of control from the prior day and yesterday's point of control were the same, that's another further indication of balance in the market being in equilibrium. And then, of course, later in the session, towards lunch Chicago time, it dropped and then it just went sideways, shifting the point of control down to 2257 and a quarter. So overall, the market auction just as expected, a normal auction yesterday, a predictable auction for the most part, one of the easier days to trade in my opinion over the last several weeks. While we're here, I want to take a moment to review what we've done for the week since I go over the weekly chart. Um, at the beginning of the week, I figured this would be an important week to look at where we end up at the end of the week. Again, this is equilibrium on the weekly. This is the last area where the market agreed substantially on a price range that represented current conditions. And then we ran away last week while keeping value down below. I spoke about this a fair amount on Monday, won't regurgitate that. And then prices basically ran away in a very thin volume push later into the week. And so we ended up with this week, and this is the current week, including Monday through Wednesday. This is the current week. We have shifted the point of control up, but the reason I'm talking about this is the point of control being up here is all well and good. The market is balancing out pretty good, but any rotation down is likely to fly right through this range. Rightly, this flagpole that we've put in is very thin, and it's likely to fly right through and get down to the first single print down here. And the target would be 2209 even. 2209 even is key below. Once we get through the 2209, we're looking at a weekly balance range between 2180 and 2200. And that's where we're likely to find equilibrium on any push down. That's where we're likely to rest. So any drop, and if you're short, then you're likely to want to hang on. Once we get below 2240, you'd likely want to hang on to 2209 all the way down to 2200 to get back in balance. Okay, so that's what we've accomplished for this week. We did shift the point of control up. As you can see, the black line has shifted up. The market is holding these prices up here, but I'm seeing signs, as I did at the beginning of the week. I'm seeing signs that this is weakening as we rise, and so just be cautious as you're holding on to those positions. for swing traders. Just be cautious to not overcommit one way or another. Just wait for the market to start dropping before you make a commitment. This is a good time to have an option play on and let one side show its push. Um, One more thing while I'm at it. It is like Friday. Hit the like button as you're heading out this after this session. I'm gonna continue talking here for a minute, but before I forget, I wanted to remind you to hit the like button on your way out. On your way out at the end of the stream. A quick pause and gear shift here towards the 10 years. The 10 years are doing something quite interesting in that the yield is above 2.6% currently. And above here, it is said that the notes become a pretty good competitor to the outlook for stocks. Even at 2.6%, it's becoming high enough that these notes are getting more valuable as they're dropping. And we have a gap since the FOMC. This is the FOMC day. This is yesterday at balance. My expectation for the notes is they're likely to start working their way back up. Likely to work their way back up. This is the composite point of control right here. And this is what things look like for the notes. They're likely to move back up, pushing yields slightly down um, over the next week or so. So I'm watching out for that to see what happens there. But the expectation is it's likely to come back into balance, back into the composite. We generally don't break away from the composite and just move away. We generally break, balance below, retest, and then balance there, and then continue the rotation down if that's the path we're taking, depending on what the Fed does and what the market's expectations on yields are. I won't get too much into that, but I just wanted to give that note out to those who are trading the 10-year that I am expecting a rotation up. As far as quickly overnight, the overnight chart's very interesting in that the overnight session basically traded yesterday's value almost to the tick. So here's value low, right at 2256.50, and here's value high. Remember the gray area, which is the high in the overnight, 2264. So the overnight session basically went and tested value low. And then found buyers and rotated up right at the European Open all the way up to value high. It's got a weak high this morning at 2264. I'm expecting that high to break, but the overnight session overall has been balanced, testing the entire value range from yesterday, and giving us an opportunity to look for a long on the open. My expectation this morning is an open auction, pull back towards 2258, chop around a little bit, and then start moving up. I'm expecting a fair amount of chop today, so I'm not expecting too much range, and I'm expecting it to hold in here, hold within the FOMC range again. So the major bias, the trades that I'm going to be looking for this morning is I'd love to see it drop down. And if it does drop down, I'm going to be looking for areas to lean against. And what do I mean by areas to lean against? I'm talking about looking at the order flow, just like we see down here. We see these areas lighting up with some bids, some steady bids. Look for areas as it drops, some collisions and so on. Again, I know this may be beyond what you're understanding right now because of the terminology I'm using. I am releasing the video from Tuesday that explains how we look for a setup and use order flow, use this to initiate trades. So I'll go over that. I'll show you that when the video is ready. But for now, that's the initial plan, is to look for areas to lean against on the buy side as the market drops. Okay, and we would be going with the flow that this is likely to continue higher. Well, I'm just not seeing the market reversing yet. Again, the opposite view is going to be hypo 2. We are opening in range in value uh, of 2 days. So we're opening inside of the FOMC day's value. We're opening inside of yesterday's value. These two are inside of each other. The market's in balance. So uh, if it does push through and take out the overnight high early, I will be looking for a fade, trading from the outside in back into the value area. And again, I'm not expecting very much range today on quad witching. And the market is likely to just sit still where it is. And so I would be looking for a push higher again, identify areas to lean against that give me an edge, and then look to short, scale out, and then hold for rotation back into value on hypo 2. I hope that's enough detail for you to use. Of course, always trade your plan, always obey your risk limits. Don't try to be a maverick today. This is not a good day to take extra risk, and it is Friday, so you don't want to throw yourself in a loop by taking a huge loss, taking some huge losses, and then being regretful throughout the weekend. It's just not a fun way, and it's not a sustainable career. And that's really the purpose of these trader bites, is to help you get your thoughts organized before the market opens, and to approach trading in a more sustainable way. I've been doing this for 16 years. This pattern is the same as what I've relayed to my traders, my prop traders. I don't tell them how to trade, but just these simple principles and a simple routine on a daily basis is really the foundation of being able to see the market for what it is, not what you think it should be. Anyway, it's like Friday. Hit the like button on the way out. Let's see how many likes we get. I'm sure there's many of you have already done that. I appreciate it. Good luck today. I'll catch you on Monday, and have a great weekend. Take care.